Hi, welcome back. Today we're at 339 Cambaugh Street. Today's subject property on the topic of cash flow analysis. We're going to be discussing the numbers behind your buying decision when you're ready to pull the trigger. Let's get back to the classroom. Welcome back to class. To succeed in real estate, it takes an extreme amount of intelligence and a significant amount of time invested in education. Get out of here! I barely graduated high school. If it wasn't for Carrick High School offering 4 periods of carpentry in my senior year, I wouldn't have made it. So let's get down to business. Let's lose the tie, lose the suit, and let's get going! Let's keep this simple. Cash in, cash out, and what's left over for you as the investor to put in your pocket. When we analyze our properties from a cash flow standpoint, we look at 2 different areas. One, if we have to rent it, how much income is going to come in, and if we flip it or sell it, how much will come in then. We always want to make sure our income analysis revolves around the rental aspect because we appreciate the constant cash flow from a rental. So let's get to the most basic accounting form, the income expense statement, but keep it simple. We have our cash coming in from rental income. That's our income. Then we have our expenses going out. That could be a gas bill, a water bill, an electric bill, an insurance bill, a tax bill, snow removal, maintenance. Then we also have a mortgage payment, which could be to the bank or to one of our investors. So we take our income minus our expenses, and that's what we have left over to put in our pocket. Pretty simple, but there's a catch. No, there's no catch. That's it. The analysis is pretty simple. It's a matter of personal preference on what the investor chooses to do, rent or flip. Let's look at our subject property, 339 Cambaugh, and look at the rental analysis. Purchase price, $42,000. We're going to do a quick renovation, spending $8,000 for a total investment of $50,000. Our rental income of $1,200 a month. We'll tell you next week how we got to that number. Our expenses, electric, gas, water, insurance, taxes, maintenance, and of course our mortgage payment based on a 5% interest rate and a 20-year amortization for a total expense of $544. $1,200 minus $544, $656 of cash flow every month, month after month. Let's look at the flip analysis. Purchase price, $42,000. We're going to put about $20,000 into making this house ready for the resale market for a total investment of $62,000. We feel the sales price for the house after we're done is about $119,000. So then we look at our holding costs. We're going to hold this property for 6 months. That's the time it's going to take us to construct, put the property on the market, and sell it. Our interest, which is going to be paid to our investor, is going to be 5% over that 6 months. The reason for that is we pay our investors approximately 10% annualized, which equals $3,000. We have utilities cost, our insurance cost, which is a construction policy. A construction policy costs more than a typical insurance policy on a house because the house is unoccupied and under significant construction. Taxes, our closing costs when we sell the property, and our listing agent fee to sell the property on the MLS. For a total of $15,500. So we take our sales price minus our holding costs minus our investment, and we come up with a profit of $41,500. So $41,500 is a lot of money. However, once you sell that asset, that makes you no more money in the future. $656 on the rental analysis side comes in month after month, year after year. And then you also still control that asset and you can sell it at a later date, realizing that $41,500 or potentially more if the market goes up. You pay your mortgage down. So we like to hold that asset for a later sale, collect the cash flows month after month. At RE360, we hold or rent a lot of our properties because we value the long-term income stream and then the appreciation and the eventual resale of the property in some date in the future. However, you can make a lot of money fast by flipping properties. So you decide. Let's take some questions from the class.
Well, how much should I expect to profit off of each investment?
That's a good question. The quick answer is as much as you can. However, because residential real estate offers a unique opportunity to leverage the entire investment, meaning using bank money and other people's money to do the deal, we ask ourselves, how much money are we going to make at the end of the day after all the bills are paid? And if that reward is worth it in relation to the risk, then we do it.
Should I flip or should I rent?
Should you flip or should you rent? At RE360, we hold the majority of our properties. We love the cash flows and we want to keep them coming in month after month, year after year. After all, we don't want to sell the cow. We want to keep milking it.
That's not a cow, that's a boar.
No, it's not. We like to milk the cow month after month, year after year, and keep making that money. You can flip. It's a great game and a big way to make money. But at RE360, we like to milk it.
There's no way that'll work. It's too simple. You need to hire a CPA, a lawyer, and get a complex analytical tool for my first investment.
Overanalysis. Analysis paralysis. 15 yards.
I'll see you next week. I'll see you next week.
Should've get down, good lord. Baby got 'em open all over town. Stick the biz, don't play around. Cover much ground.